Hello and welcome to Policy Watch, our weekly show that keeps you abreast of all the major macroeconomic developments of the week. The three major stories that we are going to discuss today are the Reserve Bank of India's second quarter review of its monetary policy for the year, the recommendations of the Kirit Parekh Committee on the oil sector deregulation, and the latest doing business report of the World Bank Group. And joining me in these discussions today is Dr. Soumya Kanti Ghosh, Chief Economist, the State Bank of India. Welcome to the show, Soumya. The Reserve Bank of India's second quarter review of its monetary policy for 2013-14 contained no surprises. The repo rate was hiked 25 basis points to 7.75%. The MSF, or the marginal standing facility rate, was lowered by a like amount to 8.75%. GDP growth projection was lowered to 5%, and the bank said that inflation would continue to rule high. Nothing to cheer. Yet the only surprise really was the market response. Far from tanking on the news that interest rates have been raised, all indices, including the Bank Nifty, shot up. Yes, we all know markets are irrational, but surely there's a limit to irrationality. We'll ask Soumya for his take, but first, this bureau report.
On October 29th, when recently appointed RBI Governor Raghuram Rajan sat to address the media following second quarterly review of its monetary policy, he made his intentions of waging a war against inflation absolutely clear by announcing the second hike in repo rate in less than a month. Short-term interbank lending rate, the rate at which banks lend to each other, was hiked by 25 basis points from 7.5% to 7.75%.
Both wholesale and consumer price inflation are likely to remain elevated in the months ahead, warranting an appropriate policy response. It was important to break the spiral of rising price pressures in order to curb the erosion of financial savings and strengthen the foundations of growth.
Improving the money supply also topped on RBI Governor's agenda as he reduced marginal standing facility rate by 25 basis points from 9 to 8.75 basis points. Reserve Bank also kept cash reserve ratio CRR unchanged at 4%. However, in yet another move to enhance liquidity, it enhanced the limit to provide term repos of 7 days and 14 days from 0.25% of net time and demand liabilities 0.5%. With these changes, there is 100 basis points gap between the reverse repo rate and bank rate, which stand at 6.75%, 7.75% and 8.75% respectively.
If you read his language in the last 2-3 policies, it is more than obvious that repo rate hike was coming and MSF rate decrease is also coming. So to that extent, I think this was more or less in broad expected lines.
Fighting inflation has assumed priority for Reserve Bank as it erodes the value of savings and weakens the very basis of financial system. RBI's decision to hike repo rate is seen an attempt to fight persistently high inflation, particularly food inflation, which accelerated to 18.4% in September due to surprisingly high vegetable prices. Central Bank also reduced its GDP growth projection for this year from 5.5% to 5% as GDP recorded its lowest growth in the first quarter of this fiscal, which was at 4.4%. Bureau Report, Rajya Sabha Television.
Soumya, I have two questions for you. One, the logic of the Reserve Bank of India's action. Even if inflation was high, as we've seen, most of the inflation is on account of food and their supply side constraints. So what did the Reserve Bank of India really expect to do with the hike? That is my first question. And the second question, if you can explain the market reaction, including your bank's decision to cut the interest rate on bulk deposits by 200 basis points when the RBI is sending a signal that interest rates are going to rise. Can you explain both these, contradictory, the second and the first, the logic?
See, I mean, the first logic I think is very simple in the sense that the increase in food inflation, it's a fact that it has been because of bottlenecks on the supply side. But one thing which we often forget is that the heightened inflationary expectations within the economy. If you look at the 3 months and the 1 year ahead inflation forecast, which is published by the RBI survey on inflation, that is running at close to 12%, and that is actually in September I think has risen more than 12%. And if you do a trend analysis, a correlation between the inflationary expectations and the CPI inflation numbers, there is a strong correlation, if not perfect. So there is a justification that the RBI, whenever it says it wants to anchor the inflationary expectations. And the other thing is that food inflation, if it is not addressed for a sufficient period of time, it gets generalized. How it gets generalized, that's a matter of empirical investigation, but there are some evidences which suggest that there is a possibility of getting generalized. Let me give an example. In 2008-9, if we remember, we had a record food grain production. Absolutely. And prior to that, we had years when we had record food grain production and the food prices inflation was at lower levels. But perhaps that was the first time when even after a record food grain production, the inflation was at very ugly and food prices I think was in excess of 15%. So that was the time when the link between a higher agricultural production and a greater
food inflation
was broken. So while that speaks of the supply side, but that also clearly gives an indication that it was first on the food prices, then it got generalized on the manufacturing inflation, and then the entire inflation rate actually went up, was higher than 8% at some point of time.
So is the bank's logic that if supply, till such time that supply adjusts,
yes,
you just have to squeeze demand? Is that the logic?
You have to squeeze a little bit of demand. And the other thing is that he has also, I mean, that is a point, answer to your second question, whether markets, how they have reacted. But I think that he has also two things has to be addressed over here. One is the cost of liquidity, which has increased to anchor inflationary expectations. The other thing which he has made is that available of liquidity. So either you adjust one of them or you adjust the other. He has tried to adjust both of them by looking at, but the policy combination which he has taken, that wants to address different issues. One is inflationary expectations, the other is in quest for a possibly interest rate regime which may be favorable in the long term.
Okay. And my second question about the market reaction, and including State Bank of India's reaction, instead of expecting interest rates to be raised, your bank has actually cut interest rates.
I'll tell you why. See, if you look at the policy, there are two things. The first thing is that the rate has been hiked for inflation expectations. Second thing is that the MSF rate has been cut. And if you look at the cost of borrowings of the banks and the fact that that window on the term repo has been extended to 0.5% of the NDTL, that means more liquidity is now being available to banks. And our estimates suggest that if you cut the MSF rate by 25 basis points, the cost of borrowings of the banks could actually decline, the weighted cost of borrowing, by as much as 30 basis points. So I think when the last time the RBI went ahead and increased the repo rate and then it did not, that is the MSF rate, the market did not realize that it was also linked to the cost of borrowing. But this time I think the markets have fully anticipated that actually it's an policy which also tries to reduce the cost of borrowing of the banks. Because
except Soumya, here I have a query, because borrowings after all should be a smaller segment. Bulk of bank business advances, investments should be funded out of deposits. So on the one hand we hear that depositors are no longer interested in bank deposits and banks deposit growth has not been satisfactory, credit has run much ahead. So at such a point, if you cut deposit rate, will it not hurt your deposit mobilization even more?
Yes, so that's why you will see, your point is well taken. That's why there is a paragraph in the RBI that he has clearly said that the bank should not rely too much also on the LAF window. They should also go and mobilize the deposits.
Absolutely.
And that is also one thing why he has also addressed this issue of trying to link those CPI index bonds in the end of November to increase the financial savings. So I think he has tried to address the borrowing cost, and at the same time he has made the banks conscious that they also have to mobilize deposits over a point of time. And to your question of this credit growth,
no, but if you want to mobilize deposits, how will you mobilize if you cut the deposit interest rate? Surely people will stop depositing even more.
No, I will tell you why. Because what is going to happen is that, I mean, the logic, I will tell you why. In the credit growth, which is now, I think there is a gap between credit and deposit in the banking system, around 18%, deposit 14%.
Yes.
So people may ask you why in this gap, I mean, how the bank, but a lot of this credit growth is actually, there is a statistical artifact over here. If you look at the latest data, the credit growth has actually declined to around 16.5%. And I believe that over the point of time, this will further adjust. Why? Because the growth in this credit was in large part because of the drying up of the CP and the CD markets because of the regime. Now they are again, the CP and the CD market is again reviving. That is point number one. Point number two is that there is also a lot of bank credit which was given to the NBFCs, non-bank financial companies. I think they had the year-on-year credit growth that actually grown in excess of 20%, 25% to be more precise, which was around 5-6% 3 months back. So that is also going to decline. So if you take out this effect, I think over the next couple of months and maybe in November, December, the credit growth will actually decline because there is not significant economic recovery as of now. So from that point of view, I think the liquidity surplus which you may be looking at this point of time, and also the liquidity surplus has been held by these FCNRB mobilization, so that is leading to an increase in the base money. And since that is also coming to an end by the end of November, so I think this enough liquidity regime, we may get into a regime which may be a little bit tighter. So that will explain the logic of why the RBI has actually done that.
So would you agree that the shift in focus towards giving savers some positive real rate of return on their deposits is a welcome shift, and it addresses something that should have been addressed long ago, because unless you have financial savings, you cannot have investment. So in this bid to raise the interest rate, of course banks have reacted the other way, but hopefully this will correct some injustice that was being done to savers in the past.
Absolutely. I think this will correct the injustice, and I think this depository adjustment is an ongoing process. I mean, whenever the banks find the liquidity, and it's always a bank specific decision. One bank can do this, other bank may not do this, but this is already completely a bank specific decision. It depends on the liquidity in the market. So my my belief is that this has been dictated by consideration apart from the RBI signal, also by bank specific factors, and over a point of time it will rectify and the market will find an equilibrium level. But I am happy that there has been a lot of efforts given to encourage financial savings, because now we have a if we do not encourage that, I mean the problem of this CAD and all those things has actually a reflection of an saving imbalance in the economy.
Okay, so it's a welcome correction. On that note, we'll take a short break, but please stay with us. We'll be back very soon. Welcome back. Which is the sector that has the honor of having maximum number of committees, committee after committee, examining the same issue? Well, no prizes for guessing. The dubious honor goes to the oil sector. Ironically, each committee says much the same thing: deregulate. This is not surprising, because the answer is obvious to all, it would seem, but the government. For nothing happens, or happens at such a glacial pace that it's almost a non-event. Will it be the same with the recommendations of the Kirit Parekh committee? We'll get Soumya in on that, but first, our bureau report.
Former Planning Commission member Kirit Parekh has recommended an immediate hike of 5 rupees per litre in diesel prices. He also recommended a fixed subsidy of 6 per litre for oil marketing companies on sale of diesel. The panel also said this fixed subsidy on diesel should be completely removed in a year's time, and diesel prices should be deregulated.
And a study we had carried out earlier at the Integrated Research and Action for Development, IRADE, showed clearly that if we had raised the diesel price 2 years ago, our inflation would have been much lower today than it has been.
The committee also wanted rationalization of kerosene and cooking gas prices for domestic use. It suggested a steep hike of 250 rupees per domestic LPG cylinder and 4 per litre hike in the prices of heavily subsidized kerosene. Presently, public sector oil marketing companies are losing 10.52 rupees a litre on sale of diesel, rupees 38.32 per litre on sale of kerosene, and rupees 532.86 on every domestic LPG cylinder. It also recommended capping the number of subsidized cylinders to be provided to customers in a year to 6 instead of 9. The panel feels these measures will cut down subsidy burden on petroleum by rupees 32,250 crores. Total subsidy bill on petroleum sector is pegged at rupees 1,38,435 crores this fiscal. However, it's not easy for the government to even partly implement them in the election year.
This report is being processed. We'll have to consult the Finance Ministry, then we'll come out our implementation formula.
The Kirit Parekh panel recommended that the government must protect India's refining industry. It also suggested a new formula for dividing subsidy burden on oil exploration companies, refining and marketing companies, and the government. Bureau Report, Rajya Sabha Television.
Well, Soumya, it does seem as if the government is almost knowledge proof, because as Dr. Parekh said, had the government done these things earlier, and it is not as if committees had not said the same thing in the past, inflation rate would actually have been lower, and yet it is a fear of inflation that prevents government from raising the rate. Is it political economy considerations that are time and again coming in the way, or what is a very logical economic exercise?
I think it's a political, it's a very politically sensitive issue. I mean, just if you give a recent example, petrol prices have been cut by 3 rupees. It's fine, you're giving, and yesterday it was cut by 1 rupee 15 paise. But what I thought that in the meantime, when we had this opportunity, instead of going for such a significant drastic cut in petrol, we could have actually cross-subsidized the diesel to some extent, because what is happening is that we are unable to increase diesel at the desired rate which it should have been. So my case is that it's a very politically sensitive issue. If you look at last year when the government went ahead and bite the bullet on increasing it by 5 rupees, if that was done in May 2000, 50,000 in 3 months earlier, the impact would have been, I mean, 1/5. Some estimates show that the objective of the government could have been met even if it raised the prices by 1 rupee in diesel, which he had to raise by 5 rupees. The objective was not met. So my point is, it's a politically sensitive issue, and I don't see much of developments in this before the elections.
Except for the fact that, you know, when the government does not raise the prices, in effect it has to subsidize, and these subsidies feed into the government's fiscal deficit and ultimately impact prices. So instead of touching my nose directly, basically what I'm doing is going around my nose and head and touching my nose. So ultimately it has the same impact. So why is government not able to tell the people that, look, this is in the long term interest? Is it purely because the government is always looking at short term gains and even completely ignoring the long term gains?
Yeah, I agree. I fully agree with you. I think people now are willing to pay a higher amount. For example, a small example is railway fares have been hiked a few days back. I think that people are willing to pay a higher amount for better service, and I don't see why people should not pay a little bit of higher amount to get a better service from there. And in terms of the subsidy which you were talking about, yes, it's a fact. This year we are already staring at
huge subsidy, yes, way beyond the 2% that we had projected.
Which could be possibly land up higher, and the RBI actually has expressed a sincere concern in these macro monetary developments about the fiscal deficit. So there is every possibility that oil subsidy may be higher, and some of this may be pushed to the next year. So I think we should do, and we should go ahead and even if not the amount which the recommendation has come to, with some little bit of adjustment, so that it helps also in the interregnum, because I think next year would not be as easy as this year, because we have got a lucky break, and there is every possibility that the Fed can come back with some tapering on the March 17-18, because I mean there is some press release scheduled. So if that is the case, then we may not be in a position to take any significant decision after that. So my hope is that instead of delaying it for the next 5 to 6 months, which seems now is the window if the elections suppose are held in the normal course of time, new government takes over in June or May end. So that will give a clear, I mean 6 to 7 months. So there has to be some decision before that, so that we can actually reap the benefits of a stronger rupee as of today. Because I still think that there is some amount of volatility left in the external sector.
No, and the case of diesel, at least one can understand, because diesel is used in transport. Of course, a large number of SUV owners also completely enjoy the benefit undeservedly. So, but even then, since diesel is used in transport, one can understand. But things like LPG, which data has shown is used essentially by the middle and the upper middle class, where is the need to subsidize? Do you think the government will go with the Kirit Parekh recommendation of reducing the subsidized number of cylinders from 9 to 6?
I don't think it will, it's very difficult, but I mean just to be, if we just put out these figures, for example, I have looked at the data very closely of this contribution. I look at the weighted contribution of the petrol products to total inflation. You will find that surprisingly, when the government went ahead and increased that one, the contribution of the fuel prices have actually declined over the last 6 months. So that's a very encouraging sign, and the consumption of diesel has also declined.
But you're still not hopeful on the government doing it?
I am still not hopeful.
Okay, but on that note, we have to slip into another break. Please stay with us. We'll be back very, very soon. Welcome back. Well, we always knew that doing business in India is difficult. What we now know, courtesy the latest IFC Doing Business India report is concerned, is that it's just become more difficult. India has slipped from a sorry 131 position in the league tables to an even sorrier 134, even as countries like Malaysia and the Philippines have made dramatic progress. Malaysia is now in the top 10, while Philippines has actually moved up an astonishing 30 places. What are we doing wrong? Rather, is there anything that we are doing right? Let's ask Soumya, but first, our Bureau Report.
World Bank's Ease of Doing Business report for 2014 covers a record 189 countries and economies in its 11th year. It has measured countries on cost of compliance with commercial regulations and strength of public institutions. Nations have been assessed on parameters like time required to start business, time required in filing tax returns, and time consumed in importing and exporting goods for small and medium enterprises that are considered engines of growth. India slipped from 131st to 134th place at a time when other East Asian countries moved up. Since last year, Philippines moved up 30 notches. Malaysia even reached in the top 10 positions globally. India lags behind China at the 96th place, Nepal, which is at the 105th position. It also lags behind the two poor siblings Pakistan and Bangladesh, who stand at 110 and 130th positions respectively. Emerging economies like Russia jumped to the 92nd position from the 112th since last year. The best 5 were Singapore, Hong Kong and New Zealand, where it takes just one procedure to start a business, while in USA and Denmark, it takes half a day and no fee to start a new business. Globally, on an average, it takes 25 days and 7 procedures and 32% per capita income as fee to start business. The latest report just covered India's financial capital Mumbai, where it takes 26 days, costs 43.3% income as fee and at least a dozen procedures to start a business. Bureau Report, Rajya Sabha Television.
Well, Soumya, as I said, what is it that we're doing wrong? Or rather, what is it that we're doing right? There seems to be so little that we're doing right. Despite whatever the government did in the recent months, they kept saying, okay, we'll open up this, we'll do further reform. But nobody seems to believe us. What is it? Is it because of the elections? Is it because we have such a long, bad track record? And how do we rectify the situation?
I think right now the investment, if you look at the investment climate and the consumption, there has been showing little bit of recovery, but I think the market is now in a wait and watch mode, particularly the foreign investment, because they want the elections to get over and then to take a decision. So, and this ranking I was not entirely unexpected, because there has been also a lot of news in the last 1.5 years for whatever reasons, 2 years, and I think that may be a possibility because of the reflection of that. And the worrying thing is that, you know, these indexes which are published by international agencies, I mean if you try to do a simple analysis, for example, I have done this analysis and I have seen that this index has a very strong relation with the rating which is given by the rating agencies. So, for example, India's macro numbers may be much better than other countries. When it comes of this, for example, these indexes like this corruption perception, you know, whatever governance index or this doing business index, they have a very strong correlation with the rating numbers. So, my thing is, even though that is no, I mean that is not explicitly acknowledged in the public domain. So, I think as long as we don't move up on this front, even though we may have a favorable GDP number, that all these international agencies giving a higher rating may not be that feasible.
But you don't think corruption is a major reason, because we've had so many scams in the recent past, and all these things do create a very adverse image of India in the international media. So would that be a significant factor?
So that is a factor, but I think that what is more important, that in terms of the investment climate, in terms of the, because there are several factors which are also under the state jurisdiction. So you have to take a holistic approach of looking into several things. For example, just a small example, the APMC Act. I mean, we know that this APMC Act has to be reformed because of the free flow of these vegetables across states, and that has not been done by all the states. So, but I think that over a point of time, if there is not a consensus on most of these reforms across the states and the center, it will be difficult for us to climb up the doing business ladder, because this rank was 132, now we have stepped to 134. This has been in any report, wherever you say that India doing business in India is difficult, you will find this data has been given. Any enforcing contracts, power situation, I mean these legal hurdles, anything you name, all of these India have a lower number compared to its neighboring counterpart.
So, in terms of attracting foreign direct investment, etc., do you think that this will be a major minus, that we are consistently slipping, even while much smaller countries? After all, you know, you look at FDI, foreign investors can go anywhere. Why would they come to India when they have a choice of going to the Philippines, going to Malaysia, which are much better countries to do business in? So, do you think this will be a major impediment to opening up India to foreign direct investment?
This is a major impediment, but at the same time, I must say that India also has been the recipient of, I mean, larger capital inflows in the past in terms of, for example, portfolios, but FDI inflows also for example, in the first quarter of this year, in this fiscal, we had a FDI inflow of 6.5 billion. So that was not a bad number. It dipped a little bit in the July, August, but overall the FDI investment is still positive. So my point, what I am trying to say is that if we get onto our higher ranking, the numbers on the FDI front could be even bigger.
So our credit ranking will have a critical impact on this. So with that, we come to the end of this program. Thank you so much, Soumya, for being with us. It's been great having you. But before we close, a quick look at the key takeaways. As far as the RBI second quarter review is concerned, Soumya feels that it's a very welcome correction of the Reserve Bank of India's policy in terms of A, encouraging financial savings, and B, trying to tackle inflationary expectations. As far as the Kirit Parekh committee recommendation is concerned, Soumya is not very hopeful that, given the political climate today and elections looming ahead, that the government will take the tough decision to raise diesel prices and deregulate oil prices. As far as doing business is concerned and why India seems to be doing consistently so poorly, he feels it's very carefully linked really to the key macroeconomic indicators. And as long as our macroeconomic indicators do not improve, we really cannot hope to improve the ranking in the Doing Business report also. And with that, it's goodbye to all of you for RSTV. Thank you so much for being with us.